As many of you may know, Stephen Lim, the Singaporean who got famous on the Singapore Idol, recently sold his Singpost shares at a low. What is even more bizarre is that he sold his HDB flats and decided to all in into the Singapore Post shares. So why Singapore Post? Stephen Lim said it is because he believes in the business and also its high dividend. Now looking back, we should know that Singapore Post is a dinosaur business. They tried to expand to e-commerce but it failed. So what is wrong? Is Singapore Post a value trap or a dividend trap? Let me give you a quick lesson. The allure and peril of dividend traps, why high yields can mask trouble. Dividend-paying stocks are a siren song for income investors. They offer the potential for regular payouts, alongside potential capital appreciation. But beware the seductive whispers of a dividend trap. These are stocks that boast high dividend yields, but come with hidden risks. What is a dividend trap? A dividend trap is a stock that offers a deceptively high dividend yield, often accompanied by a declining share price. This high yield can be enticing, but it might be a sign of underlying problems in the company. There are two main reasons a company might offer an unsustainably high dividend. Financial strain. A company facing financial difficulties may prioritize dividend payouts to appease investors, even if it means jeopardizing future growth or dipping into reserves. This can lead to future dividend cuts and a declining stock price. Maturing industry. Companies in declining industries may offer high dividends to compensate for a lack of growth prospects. While the dividends may seem attractive, the stock price is unlikely to appreciate significantly. How to avoid dividend traps? Don't be fooled by just the headline yield. Here are some red flags to watch out for. High payout ratio. The payout ratio is the portion of a company's earnings that it pays out as dividends. A payout ratio exceeding 70% might suggest the dividend is unsustainable. Mounting debt. Companies that rely on debt to fund dividend payments are at risk of defaulting if their financial situation worsens. Declining earnings. A company with consistently declining earnings is unlikely to maintain its dividend in the long run. Looking beyond the yield. Focus on companies with a strong track record of dividend growth, healthy financials, and sustainable business models. These companies can offer a reliable stream of income alongside the potential for capital appreciation. Remember, high dividends are great, but they shouldn't be the only factor when choosing a stock. Do your research, understand the company's fundamentals, and avoid the allure of the dividend trap. Let's focus back on Stephen Lim. After he sold his shares, the shares jumped by more than 10%. Is it bad luck? Why does it happen so often when you cut your losses, the shares jump? Why you should not time the market. Don't try to be a market wizard. Why timing the market is a recipe for disaster. The allure of timing the stock market is undeniable. Imagine buying low and selling high, profiting handsomely from every market swing. But the reality is, consistently timing the market is a fool's errand. Here's why you should focus on a long-term investment strategy instead. The market is unpredictable. Financial markets are complex ecosystems influenced by a myriad of factors, many of which are unforeseen. Economic data, geopolitical events, and even investor sentiment can all cause sudden shifts. Predicting these movements with any degree of accuracy is nearly impossible, even for seasoned professionals. Missing out on gains. Trying to time the market often leads to investors sitting on the sidelines waiting for the perfect entry point. But markets tend to trend upwards over the long term. By missing out on even a few good days, you can significantly hinder your returns. Emotional investing. Market timing is a recipe for emotional investing. The fear of missing out, FOMO, and the urge to sell during downturns can cloud your judgment and lead to rash decisions. A long-term strategy helps you stay disciplined and avoid these emotional pitfalls. Time in the market versus timing the market. The key to successful investing lies in time in the market, not timing the market. By consistently investing over a long period, you benefit from compounding returns and market fluctuations tend to average out. Even if you experience short-term dips, the market has historically recovered and grown over time. Focus on the fundamentals. Instead of chasing short-term gains, focus on investing in companies with strong fundamentals. Look for businesses with a solid track record, good management, and sustainable growth prospects. These companies are more likely to deliver long-term value for your portfolio. Develop a disciplined strategy. Create a long-term investment plan that aligns with your risk tolerance and financial goals. Diversify your portfolio across different asset classes to mitigate risk. Invest consistently, regardless of market conditions, and avoid making impulsive decisions based on market noise. Remember, investing is a marathon, not a sprint. By staying focused on your long-term goals and avoiding the temptation to time the market, you can increase your chances of achieving financial success. So now you know why you should not time the market. So what happened to Stephen Lim after he realized his loss? Guess what? He put that remaining money into gold. Gold is a solid investment, but it is at an all-time high. Is it wise to invest in gold? Whether or not it's wise to invest in gold depends on your overall investment strategy and risk tolerance. Here's a breakdown of the pros and cons to help you decide. Pros of investing in gold. Hedge against inflation. Gold has a long history of holding its value during periods of inflation. When the value of currency decreases, gold tends to rise in price. With current inflation concerns, this could be a good time to consider gold. Safe haven asset. Gold is seen as a safe haven asset during times of economic or geopolitical uncertainty. Investors often flock to gold when the stock market is volatile, potentially offering some protection for your portfolio. Tangible asset. Unlike stocks or bonds, gold is a physical asset. You can hold it yourself or store it in a safe deposit box, offering some investors a sense of security and control. Highly liquid. Gold is a very liquid asset, meaning you can easily buy and sell it on the market. This allows you to access your investment quickly if needed. Cons of investing in gold. No passive income. Gold doesn't generate any income, unlike stocks that pay dividends or bonds that pay interest. Your return is solely based on the price appreciation of gold itself. Limited growth potential. Gold's price growth can be slow and stagnant compared to stocks. While it may offer stability, it might not outperform other asset classes in the long run. Storage costs. If you choose to buy physical gold, you'll need to consider storage costs and security risks. Secure storage facilities can add additional expenses to your investment. Volatile in the short term. Like any investment, gold prices can be volatile in the short term. While it may be a good hedge against inflation, the price can fluctuate significantly. Here are some additional factors to consider. Your investment horizon. Gold is generally considered a long-term investment. If you need your money in the short term, gold might not be the best option due to potential price fluctuations. Your risk tolerance. Gold can offer stability but may not offer high returns. If you have a higher risk tolerance, you might consider other investment options with greater growth potential. Your portfolio allocation. If you do decide to invest in gold, it's wise to only allocate a small portion of your overall portfolio. This helps diversify your investments and reduces risk. Overall, there's no one-size-fits-all answer to whether or not you should invest in gold now. Carefully consider your financial goals and risk tolerance before making any investment decisions. In conclusion, I feel that Stephen Lim made all the mistakes that newbie investor made. It is understandable as he seems to care only about the attention that he is getting, rather than doing his due diligence. So what will happen to his gold investment? Let's wait and see. Take care. And I see you in my next video.